If you'd been right here, of course, you would have heard first what the rest of the financial press is now putting together, and that is that the Senate and House conferees have agreed on a broad blueprint that goes something like this: an individual top rate that falls to 37%, a corporate rate that will be at 21%, and they do address the alternative minimum tax, but largely for corporations. What's still stuck in the thorns here is how to deal with that for individuals. But at this point, it does seem to be closer to what some congressmen and women have been calling for, but not necessarily what all senators have been calling for. And that, of course, is where that margin is tight. And I'm talking that even before the Alabama election yesterday that produced another Democratic pickup. Let's go to Market Watchers Jay Pelosky and Jonas Max Ferris. Jay, to you first. The market still seems to like this and that it's moving the ball forward, but there could be some early trouble here. What's your sense?
Well, I think, Neil, there are really two sides to it, right? On the plus side, this is clearly going to be beneficial for corporate earnings. Earnings are what drive stocks. It's not economic growth. It's earnings that come from growth or come from tax cuts in this case. That's the positive. On the downside, I think there's risk that you have a inexperienced new Fed that may be pushed into a little bit of a potential policy mistake with tax cuts coming into a late cycle, near fully employed economy.
You know, it's anyone's guess how the market ends up today, Jonas, but the betting was, look, corporate rate is dramatically lowered. Now rates at the top could be lowered. We don't know what possible offsets are there outside of losing, you know, the state local tax deduction. And even at a $10,000 figure, I would imagine even bringing it down to 37% wouldn't fully solve that problem for the well-to-do. But it inches toward doing that. What do you think?
Yeah, it's not, you know, it's not a terribly inflationary tax cut package. It looks like it's going down. It got a little more so just now when they lowered the top tax rate a little more than it was. But it's still, the top tax rate is still higher than it was under the Bush tax cuts for the top tax rate, which I think was 35%. This is primarily a corporate tax rate. So you're not, you know, we're running a strong economy, unemployment's low, but this isn't going to increase demand hugely to the point we're going to have 4% inflation all of a sudden, and the Fed needs to jack interest rates up to the moon. I mean, at the end of the day, you're cutting corporate taxes. That's the biggest tax cut here, and that's right. You know, that's going to lead to more production, more prices, and also with the mortgage stuff coming out, there could be less demand for commodities, homes. It might not be inflationary at all, and more importantly, the Fed doesn't want to raise rates in anticipation of a tax cut that still might not happen. So, like, they're in a kind of a bind here. Then they're watching these asset bubbles form in cryptocurrencies and the stock market. So they're kind of in a dicey situation where they don't want to cause a recession, but they want to limit the speculation, and yet they don't know. Inflation's not high right now.
But they are expected to raise rates today, and then it's anyone's guess what they do in 2018 and what effect this would have. That is the tax cut, which would normally be stimulative. But Jay, what do you predict? I think consensus says there are going to be at least 2 more quarter-point hikes. What do you say?
Right, Neil, I think the market has moved to 2 hikes next year. The Fed is currently saying 3. We'll see what they say this afternoon. Some prognosticators are saying 4. I think the risk is that we have a yield curve which is quite flat, right? It's 60 basis points between the 2-year and 10-year. If the Fed raises rates several times while the long end of the curve is protected by demand for long-duration safe assets, you could lead the Fed into creating an inverted yield curve, which in turn the market could look at as a sign of recession and have a significant stock market sell-off. So I think it's a little ironic that potentially the tax cut, which is viewed as something pro-growth, could actually turn out through a mistake or two on the Fed side as being negative for growth and creating the conditions for a stock market sell-off and a recession late 2018, early 2019.
Do you see that happening, Jonas?
I think there's a risk of the Fed, and this has always been the case, they raise rates to kind of stop assets grow faster than the economy. It happens all the time, and then they try to deal with it. It happened in '29. It happened before the real estate crisis, and then they cause a recession essentially, which does the effect of hurting the stock market. But realistically, we don't have the kind of inflation that would require a very high interest rate. Yeah, you can go a quarter point, a half point, but longer-term rates are not going up in proportion because inflation's not there, and there's a huge amount of demand to own income-producing assets by retirees, et cetera, et cetera. So they don't really, they're kind of in a bind. They want to stop the speculation. They want to get to a normal rate, so to say, but they don't want to cause a recession to do it.